Hello, this is Stuart Fleming. Tonight I'm going to go over the steps I take when I am evaluating a stock, whether I want to purchase it or not. I'm using IBM as an example here because it's a pretty good stock. And you can see that I've got Yahoo open, which I use as my fundamental resource. It's got pretty much everything I like to look at. And we're looking at the summary page. Quotes are entered up here in the upper left, and you first get a page that shows basic information about the stock and a small, quick, and dirty chart. Okay, we can look and see that the stock is at 195 and the 52-week range is between there. So it's not quite at its highest, but it's kind of not quite exactly in between. The market cap is 220 billion, which means it's a pretty big stock, and the PE is 14. 14 is pretty average. The stocks like this tend to go between 13 and 15 depending on how their sales are going. The earning per share is very important because that has direct impact on the dividend, which is here. So you can see that every year they pay $3.40 for each share that you have. That works out to about $1.80. And they do it over 4 periods. So each quarter there is a payout. And so it's quite a small payout when you consider that it's divided out by 4. But this is a very good ratio because 3.40 over almost 14 is a 30% payout about, and that means that they have some room to grow the dividend. It also means that if their sales go down, the dividend isn't going to be borrowed. They're not going to use borrowed money to pay for the dividend. Okay, so the next thing I would do is I would look at the key statistics here. And this gives a bigger overview. Here you can see that a lot of the information, and some people use this, I don't use that so much. What I do look at is the return on assets. I basically like to see that these are positive numbers, and 73 is a very good high number. Their revenue, quarterly revenue growth is obviously a little red flag here. And you can see that this is a low flag here too. They have a lot of cash. They also have a fair amount of debt. Now, the ratio isn't that bad because 12 billion and 30 billion, that's almost 1/3. But it is a fair amount of debt. That's something to consider. But they do have a fair amount of revenue, and their gross profit is for 50 billion. So maybe that amount of debt is not that terrible. So I would look at all of those numbers. The next number that I would look at is, as I said, the dividend and the payout ratio, which is down here is 23%. I misread that earlier. The dividend date was December 9. It is currently December 19th, so I wouldn't buy this for a couple of months because there's no reason to buy it without getting a dividend soon. Some people play just for dividends. And I would look at the shares short. And shares short is currently, well, prior month was 15.43 million, and now it's edged up to 15.5 million. And you can see that this and this indicate the percent of float that is short. That's actually a very low number. If we then go over to a chart, I use the Interactive chart, and I like to use the candlesticks, and you can see now that you can enter symbols here. I have dividend shown, and you can see that the dividend was here. I also use technical indicators. Click on that. Simple moving average, a money flow, MACD, and relative strength. And then the chart settings that I have, I like a linear. Some people use log, and the line type is candlestick. This is just showing that over here you can see the values. Now you can see that the stock hasn't really moved almost in the last, since February almost, maybe even a little further. If you come down here, you can press 2 years and get a little bit bigger view. And you could almost go back to October of 2011 when it started reaching this level of 190, and it just kind of hasn't moved much since then. And there was an extremely good uptrend for quite a long time, but it seems to have petered out a little bit. Another thing nice about Yahoo is that you can move this with your mouse to see previous periods. Or, of course, down here, you can put in the date, or you can use this slider here. Now, another thing that's very nice about this Yahoo is that you can see the percent very quickly, what it's gone up. Having gone up such an extreme amount since 2009, you have to wonder whether it'll continue going up. 2008, let's see here. But you can see that it has gone up, and it's kind of tiring out that trend. So this might be something that you would wait on, because it doesn't look like it's going to go too much higher, at least for the time being. When it gets above, what is this value here, 210, then it will probably continue moving. Like here you can see from this period in 2010, from this period to this period, it didn't move at all. That's almost 6 months. If we look at the MACD, MACD is relatively interesting because you have 2 lines. When the blue line crosses the red line, it tends to go up. And here you can see that as my cursor goes down, it's actually the MACD is going down, but the stock is going flat. Here you can see that it's rising again. So even though it's going up and down, it's still going up in an uptrend. Now here you can see that from here to here, the MACD is reaching a lower high and the lower lows. So that is oftentimes a pretty good indicator that maybe the stock is no longer going to continue on its uptrend. You can also look at the relative strength, and here you can see that the relative strength is oh, sorry, this is money flow. The money flow index is quite low, and if we go down further, the relative strength here, it's edged up a little bit, but it's not that healthy. One of the things that I often do is when the relative strength is 20, I might consider purchasing it. Or actually a little bit after 20, because you can see here that this relative strength here is lower than this one right here. And look at my mouse here down at the bottom, lower left. But the price is lower. So generally I wouldn't buy it right now because I think it's overbought, but I think it's going to either go flat for a while or go. Let's take a look at CHK. Now this is a stock that is in the news recently because Carl Icahn put some money into it. And let's first of all look at the summary. Earnings per share is minus 120. The PE is NA because there's nothing to make price earnings on. They still have a dividend though, which is pretty amazing. So they either have cash or they're borrowing money to pay the dividend. If we go to key statistics, you can see that their market cap is 11 billion, but their enterprise value is 28.39 billion. Why would that be? Well, current debt is 16 billion, and oftentimes they add the debt to the market cap to achieve the 28 billion enterprise value. They have negative profit margin. Return on equity is negative. They do have a fair amount of revenue, but they have terrible quarterly revenue growth. Their net income is minus 76 million. They only have 142 million in cash, and they have a huge amount of debt. They are selling assets as we speak. And if you look here, the 52-week change is minus 26,000 or 26%. And the short ratio, they had 75.78 million shares short in the previous year, previous month, I'm sorry. And right now it's up to 83 million, so more shorts are attacking it. So it's really not quite a good stock to own right now. If we look at the chart, you can see that it's been in a very long downtrend. And you can see that it's for pretty much the whole time below its 200 moving day average. Now granted, it has been under its 200 moving day average since October of last year, I believe, yes. And it's getting closer to it, which is a good thing. You can see that this is down here, this is when Carl Icahn purchased it, and it was at kind of a low. It went up a little bit, but it's still at that low. And if you look at the MACD, now this is one of the nice interesting things about the MACD. Here, this is a little bit lower than it is now, even though the price is almost the same. So that could be considered a good thing, although we might see the stock sink further, especially given the amount of debt that they have and the quarterly revenue problems that they're facing. So this stock would be questionable buy at this point. Let's look at GLW, which is, Corning. This is an interesting stock. If you do max down here, you can see that it was an internet baby. There, that's pretty good, huh? And you can see that for a long time they paid dividends. For a long time it went absolutely nowhere, and then it went to heaven during the dot-com bust, or dot-com craze, and then down to 2 in the dot-com bust, and then briefly up to about 25 or so. So it had a very interesting history. The last 5 years, let's look at actually, we can just scroll over here. They didn't have dividends, and they started doing dividends in late 2007. But it's been suffering, and mainly because the TV market is poor right now. So you can also see that it's relatively below its 200-day moving average. However, it's at a very good yield, and the dividend is quite well below the earnings per share. It's got a PE of 10, which is low, and the MACD doesn't look terrible. It doesn't look extremely good right now, but it has been bottoming out. Let's put it that way, I think. If we go to key statistics here, you can see that they don't have a bad return on equity. It's not great, but it's not terrible. They've got a minor problem here. This is pretty low, and I would indicate that that's from the problem with TV sales. They've got 6.5 or 6.35 billion in cash and total debt of 3 billion, which is quite reasonable. They don't have a lot of shorts in the stock, and so it's a reasonable buy at this point as a value. It's got a good yield, and it may be that as the economy gets better, they'll be a good purchase. Okay, that should give a pretty good overview of what I think is a good buy for evaluating stocks.